What's up, B2B fam? It's your boy Michael T. Ragland here. We're going to get right into it. Today, we're going to cover one of my favorite topics. Have you ever watched people make these crazy gains and then you look at your funds and you're like, I don't have as much money as them. How am I going to actually increase my leverage so I can make these gains too? So today, we're going to be taking a deep dive into options and running through how they work. But before we get into it, you need to understand that options are financial instruments that give you the right, but not the obligation to buy or sell an underlying asset. That's the definition of options. The great thing that I love about options is that each contract is made up of 100 shares. And that's how you can really make those big multiples on your money. But before we dive deep into that, we got to talk about the basics of options, and then we're going to work our way through it and get more advanced as we go. So if you don't have your notepads out, get them bad boys ready because we're going to dive deep in this one. All right, let's dive into the different types of options. So the most popular one is going to be call options. Remember, it gives you the right to buy an asset at a set price during a certain time frame. So think something's going to go up, those are call options. Then you have your put options. That's the right to sell an asset at a set price. You think it's going to go down? Those are put options. And just for a quick example, let's say that you buy a call option for Apple with a strike price of 50. Man, I wish it was $50. I wish I was around when it's $50. But anyway, and that stock rises to $60, you can buy it at the lower strike price and sell it at the higher market price and get the difference, in this case, which will be $10, right? Minus fees times 100 shares. Because remember, each contract is 100 shares. And then put options are going to be the opposite of that, right? So if I buy a put option for a stock that's at 50 bucks and it goes down to 40 bucks, I get the difference being $10. If I'm wrong, I lose the money. Pretty simple, right? Calls, I think it's going to go up. Puts, I think it's going to go down. Very simple concept, but you really need to understand that before we move further and go deeper into the strategies behind options trading. And we're going to go to some fundamental ones, and you really need to know, of course, how to buy call options, but also how to buy put options, how to sell covered calls, and selling cash secured puts. There's a lot of other stuff, but we're going to keep it simple and keep it at that as we start out and get you indoctrinated into the options trading game. Let's look at a quick example of buying call options. First of all, don't judge me. I know I write in secondhand reverse pig Latin. Hey, I mean, I couldn't have everything, right? I had to have some kind of deficiency. But anyway, in this example, we're looking at buying a call option, right? So in this case, we're buying something at a $100 strike price. Boom. We got that. And then when it expires or we sell it, it's at $120, and we had a $5 premium or cost. That's how much it cost us to get the right for one contract, was at $5. So all we really need to know is that, cool, I bought it at $100 strike price. When it expired or when I sold it, it was at a $120 strike price. Therefore, I made $20. But here's where it gets fun, right? Because like we always talk about with options, it's actually each contract is worth 100 shares, meaning that I made 20 times 100. So 20 times 100 is 2,000, right? Inside of there. And then I have 5 times 100 is what I paid. So without being a mathematician up in this piece, it's pretty simple to look at it. So my actual profit is going to be that 20 times 100, which is 2,000, minus what I paid for my premium. So in this case, it's going to be 1,500 bucks. We all can see that 1,500 bucks is going to be what I made off this actual options contract or trade inside of it. But remember, there's going to be fees and stuff with brokers, so we could subtract whatever those fees are. But for all intents and purposes, I made 1,500 bucks off this deal just by a $20 price move within the time of me holding this option. And there's a lot of other things as well. Like I have a cheat sheet that I'll link down below where you can look and actually see all the different things that affect options. We have something called the Greeks, which I'm not going to get into in this video, but I do have those definitions broke down in the link below. You can understand all that stuff. So there's other factors at play, but just for simplicity's sake, without putting the Greeks into mind and time decay and so on and so forth, we're just looking at a $1,500 profit on that trade that we just kind of laid out. And I just want to show you again, just keep it simple. I really want you guys to be able to break these generational financial curses. And I wouldn't say it's an advanced thing. It's an intermediate thing to understand when it comes to options. But I'm going to walk through it one more time. Remember, we had $100 strike price. Boom. And we bought a call option and we were like, okay, we feel like it's going to go up. We didn't know how far it was going to go up, but by the time that option expired, or better yet, when we sold it and wanted to take profit, it was at $120. We paid $5 as a premium, but that's $5 per share, meaning that it was $500 to execute this trade. And the upside was $2,000. And the downside was we could have lost, $500 if we were wrong in this case. So very simply, we went in and we're like, okay, we have 20 times 100. Remember, we went up. Our profit was $20. We times that times 100 because we have 100 shares in each contract, and we made $2,000. And then we had to pay $500 just to get the right to control those 100 shares because it was $5 premium per share inside of this thing, meaning that we made out with a $1,500 profit before fees and all the Greeks really kicked in. That's just a very simple explanation of call options. Let me know in the comments if all that makes sense. Cool. But we're going to continue rolling on this thing. Put options are the opposite of that. So if we bought that thing at $100 and it went down to $50, we had a $50 profit there, and then we just got to work the numbers again to see what our profit was. Very simple. It's just the opposite of that example that I just laid down for you for just straight up buying call or put options without considering the Greeks or anything else. All right, cool. Now we're going to step it up a little bit. We're going to talk about selling covered calls. And this is a way to make income off stock that you already own. Let's say that I earn a lot of shares that are trading at $80 per share. I can actually sell covered calls against that stock. So let's just break it down with a quick example. So I have shares that are valued at $80. I can sell a call option to somebody that really feels like it's going to go to $90 based on whatever reason. I don't really care about their logic, but I know I can make money. But the money that I make as the actual owner, and this means that I don't own options. I actually own those shares outright, paying the full price, right? To actually do this. You can't do this with options. You have to own the stock. So if I actually own that stock, and it's people out there, trust me, there is, that's like, hey, this is going to go to $90 and I can make some money based on our previous example there. I can go in and make money just off selling these covered calls against what I have. It's risky though. And let's kind of break it down real quick. So if I go in here and I'm like, cool, we already established that I have something that's valued at $80. Cool. Well, if I sell that call option with a strike price at $90, a person on the other side is like, okay, I'm anticipating that if this thing goes up $10 and I have 100 of them in my actual contract, I can make $1,000, right? So very simply, that $10 times 100 equals the potential to make 1,000 smackaroonies if I'm the person that's buying this call option from me because I own the stock, right? And I've sold a covered call against it. So pretty simple, right? If I go in there and I'm like, cool, I own it, it's worth $80, I can sell covered calls against it to people who feel like it's going to go up to $90 or to wherever. But in this case, let's say that $90 is where we see is going to go up, and that's the strike price that I sold it at, because I feel like hopefully it doesn't go above that. But there's other people that think that it will. The person on the other side of this transaction feels like, hey, I have an opportunity to make $1,000. And then let's use that same premium before. Let's say that it's $5 per share here. And then this person's like, cool, well, remember, it's 100 of those, so they're going to have to pay $500 to actually get access to the right to buy my shares in this case, right? So very simply, I know that this person on the other side saying, okay, I can risk 500 to make 1,000. And for me, I have risk because if it goes over $90, well, I'm forced to sell it at that price, right? So that's where it gets dangerous. But if I feel like, hey, people are speculating, this thing really probably won't move above, that $90 strike price, if this person is wrong and it doesn't exceed that $90, guess what happens to little old me back up here who actually owns these shares? I got to, it's like Monopoly. I got to go back and collect that $500 premium that that person paid. Because remember, if they're wrong, they lose their money. So the thing about the share market, there's always somebody on the other side of the deal. And I love being this person. I love having those at least 100 shares valued at $80 sitting on the other side and being like, you know what? Yeah, I'll take that bet. And I make $500 with, I mean, it's risk there. I wouldn't say little risk, but if I'm educated, I can play this game all day if I have a good amount of a certain stock. So hopefully that all makes sense. Let me know in the comments if all this stuff is clicking for you. This is my first time trying this style of video, but I think it's super good. And I know when I watch it, it really broadens my understanding. I've always been conscious of my terrible handwriting, so I tend not to use examples, but hopefully by seeing it in even in my secondhand pig Latin and us kind of talk through it as you write it down, it makes a lot more sense for you. Let me know in the comments if it does. Anyway, let's move on to the next example. So if we can sell covered calls. All right, this is where we're going to step it up a little bit further. We're going to talk about selling cash secured puts. So what this means is that I have enough money in my account to actually sell put options to kind of average down or buy things at a price that I want, or to collect a premium if the price of that stock stays above my strike price, right? And once again, let's go to the example. So I got a cash secured put here. I have at least $5,000 in my account. This is what makes it cash secured, right? Because there's a couple things that can happen here. So if the option expires worthless, I just get to keep whatever premium they paid. Very similar to what we talked about with selling covered calls. So if the person on the other side of this transaction paid a $500 premium, I'm going to be able to keep that premium if they're wrong. And that means that if the person on the other side of this transaction is wrong, I get to keep the premium. Remember, the premium is the price that they paid for the option or the right to actually enter into this agreement with me. So if they're wrong, I keep their money. And since it is a cash secured put, I have at least $5,000 in my account to cover it if I'm forced to buy it. And if I'm right, I just keep their money. This feels so much like Monopoly. That's why I love it so much in the game. But I like to show these examples to break it down. So in this example, there's a put option that I'm selling, right? I can do that because I have enough money in my account to cover it, and two things can happen. So say the other side is right, and I actually am forced to buy this actual stock. I take my $5,000 and I buy it. Now it's mine. I can do whatever I want with the stock. But if they're wrong and that actual strike price, if the price stays above 50 and doesn't go below, because remember, we're dealing with puts here. So if it doesn't go below, all that means is that I keep the premium, which is whatever they paid, to actually get into the deal with me. Right? Hopefully you're still sticking with me, because it does get a little convoluted when we're looking at it, but it's not as hard as it sounds like. If you just look at the examples, ask the questions in the comments, we can really work our way through this, because this is a game that I think a lot of people are intimidated by. Like, it's simple math. We all learn this stuff in school. We just have to learn what all these terms are. I think sometimes Wall Street puts these terms out or these strategies just to confuse us, so we can't make our way to generational wealth and we stay struggling in 9 to 5s. That's why I'm really taking my time on this stuff. So I hope everybody can understand, but these are cash secured puts and how the game works. Cool. All right, let's move on to a little bit more advanced section. We're not going to spend a lot of time in this section, because I feel like if you're just starting out in options, just buy call options, buy puts. If you get to that point to where you have enough capital or enough shares, you can start getting into actually going into some of the other strategies like the cash covered puts or selling covered calls, but you don't have to. But for my people who really want to step it up and actually kind of hedge their bets to minimize risk, these are the other things we can talk about. So we can talk about vertical spreads and iron condors. I swear iron condor sounds like a movie with like Louis Gossett Jr. from the 1990s when he was like a fighter pilot, and it's like, push it to the limit. Anyway, I digress. But Let's look at a bull call spread. So let's say you buy a call option at a lower strike price and then sell another call option at a higher strike price. This is going to limit your risk, but it's going to also limit that reward as well. So let's say that I buy a call at say 50 bucks, then I sell another at 60 bucks. Well, that's a spread, right? A bull call spread. I can't make a lot, but I also can't lose a lot, and I can kind of play the game there. If I feel like something's just like herky jerky and crazy, I can do that. I can use these vertical spreads to kind of protect myself. Now let's get into our iron condor. Push it to the limit. And you selling out of the money put and call, and then you can buy a further out of the money put and call. And this strategy is really gonna profit when there's low volatility, where the stock price stays pretty much within the range. You really don't want to do iron condors on these super volatile stocks. Like when I do this type of stuff, I look at like super boring, very strong companies, but they really don't move a lot. I'll do the iron condor strategy. And honestly, it's so boring. I don't do it a lot, but it is an option there if I really feel like it's the perfect strategy for this particular stock. The reason why I give you guys all these tools doesn't mean you need to try to use them every time you step up to the plate, but I want you to know how to actually swing when you get up there and understand what tool best fits the purpose or the market conditions. And that's why in all these videos on my channel, I talk about understanding sector rotation and economics and all the stuff that the Fed talks about, because with these strategies that I'm teaching you, all of these things are going to be important, but only during a certain market condition or when a stock is performing a certain way. But if you don't understand the basics, you can never get to this stuff. So if your head is spinning right now, go back to the beginning, go down to my channel and look at some of the more beginner level videos to really get an understanding of this stuff before you dive deep into options and really start trying to apply leverage and putting on a little bit more risk, which is super important. Is why we need to talk about risk management for a little bit. So when we talk about risk management, the simplest thing is just setting a stop loss to stop the bleeding. Because anytime, especially if you're like really on the charts, you're like, oh, it's going to reverse. It's not going to go against me. Like I remember I was sitting in this office and I was really playing around and I was trying to day trade. But keep in mind, even though I'm American, I actually live in Australia. And it was during the worst time ever because I was doing London at the time, and London was open like when it's dinner time or when my kids are all from school and supposed to be doing homework with them. And I have my daughter in my lap, my son over here doing his homework, and I'm sitting here trying to day trade. And I jumped into a trade that I was like, yeah, this is definitely going to go up. Like I've looked at the charts, like everything feels good. I got my signal to jump in based on some technical stuff I was looking at, and I got in that trade. And it was going well for me. And I was kind of riding it out and looking at the data. And I knew when I wanted to take profit, but something happened. Another market opened up and it started dipping on me. But I was so distracted with my family and everything happening around me. I ended up staying in that trade. And I don't know why I didn't set a stop loss. Like I'm telling you guys this stuff, but I was so confident on the technical freaking charting that I had did and the data that I had that I felt like it was never going to go against me. But long story short, it was only 30 minutes just as I sat here and I sweated it out because I thought it was going to reverse, but I lost like, I don't know, 600 bucks or something just like that by not setting a stop loss and proper position sizing in this case, because I was trading Forex, which is another topic. But just because I didn't set a stop loss and I was stupid, that cost me a lot of money. And it's people that got way worse stories than me. I've done it other times as well. That's just the most recent one that I can remember when I didn't have that proper risk management. But remember as well, look at your total portfolio. Like I've already talked about investing in ETFs and REITs and other like slower, boring or sector specific things. That should be the lion's share of your portfolio. You should take, I don't know, 2 to 5% of your actual portfolio to mess around with this option stuff just because it's so risky when you starting out. Don't take your whole bag and throw it at options because it's just too risky when you're starting out. But simple, simple, simple. Like those stop losses. I'm sitting here and I'm like, cool. I've maybe got into a trade when I'm like, all right, this is a call option. I feel like I want to be Gucci if I can take this thing from $10 to $15, whatever. You know, we're just using random numbers here, but it starts going against me. If I say, you know what? If it goes below $7 and looking at some technical data, I'm wrong, right? And this is why charting and understanding support and resistance or supply and demand or Fibonacci, whoop-de-whoop, whatever you call, whatever your strategy is, there's so many out there. I don't really care. I just trade supply and demand or support and resistance. I keep it super simple and I try to follow the big boys, right? And latch on to what they're doing. But whatever your strategy is, you have to understand not only the fundamentals, which I talk about a lot on this channel, but also some of the technical side as well, just basic stuff to be able to actually properly do risk management. So once again, if I'm sitting here and I'm like, cool, I get something and buy it at $10. I feel like if it hits 15 bucks, I'm gonna go ahead and make my profit and get the hell out. But if it goes to $7, I'm also gonna go out because my thesis was wrong. That's what a stop loss is, and that's risk management. That's why it's super important to do these things. But I'll also touch on it one more time. Make sure you're not using the bulk of your capital to jump in to trading options. If you got like 10,000 bucks, only take 2% of that on one single option trade, meaning 200 bucks. You got to find stuff with a $2 or lower premium to actually be able to get in on that options play, right? Based on all the stuff we talked about before. But be very, very careful with options. But man, they are powerful because it's one of my favorite words. I think one thing that a lot of people are struggling in life, in financial, in jobs and whatever, is because they don't have leverage. And options give you leverage because you can pay, say 200 bucks in this case, you find something with a $2 premium per share and actually get access to 100 shares of something and benefit on the upside if it goes up, or vice versa if you're messing around and buying puts. It's crazy. And even when you have money, you can sell covered calls and then you can play around with cash secured puts. One thing I didn't talk about is that you don't have to actually own the stock to do a cash secured puts. You just have enough money to take ownership of the stock if you're wrong, right, in your bet against the person on the other side. Hopefully now you have a solid overview of this stuff, but I do have a resource called Options Unlocked that's linked down below if you want a in-depth guide and strategies to elevate your trading game. And if you want to dive deeper, there's also a pre-link to the options course that I'm building out as well. And in that Options Unlocked course, we really dive deeper and I'll go into comprehensive insights and we'll do some hands-on strategies and everything to really get in there to understand options trading because it's super important. It's why I love the term each one teach one. Like we can come into the community and actually help each other out to lift each other up because our goal here is to break those generational financial curses so you can leave more behind for your family when you die than just debt, fam. Let's get it. And if you love this video, check out this video right up here somewhere because it is a banger as well.